I'm Angie Austin with Oil and Gas 360, and we are here at EnerCom's 2018 Oil and Gas Conference in Denver, Colorado. And joining us is Luke Essman. He is the president and CEO of Canyon Creek Energy. Welcome, Luke.
Hi, thanks for having me.
All right, let's talk a little bit, just a quick rundown of your company's core assets, what they are, where they are, and briefly talk about your approach to drilling and developing them.
Yeah, sure. Thanks for having me again today. We are headquartered in Tulsa, Oklahoma. We are active in the Arkoma Basin in eastern Oklahoma, principally focusing on a stacked pay basin there. It's an extension of the Woodford Shale, the Mays Shale, and then the Caney Shale as well. We control about 100,000 acres, currently running one rig with additional activity to come in 2019. So we're pretty excited and proud of the asset we put together, certainly on the private side, and have a pretty rapid growth plan ahead of us.
Let's talk a little bit, Luke, about something you've learned from drilling and producing your assets that's unlocked, how you can get more out of those assets.
Yeah, I think our story is very similar to a lot of the other plays in the U.S. where we're utilizing the modern drilling and fracking techniques that are rampant through multiple plays across the U.S. Our lateral lengths are extending, sometimes 2 miles or longer, so the drilling efficiencies with that are certainly prevalent in our play. Multi-stage fracking, stage spacing has also been very important on unlocking our reserves. So we've taken our production from what was done maybe 5 or 6 years ago upwards of 200 to 300% higher with today's drilling and completion technology, and it's delivering pretty exceptional returns on our play.
It's wonderful. All right, you talked about some of that new tech, so let's get into more specifics. What new technologies are you seeing out there that are likely to become commonplace in the oil and gas industry over the next few years?
We have been utilizing a cyclical frac in our completion. So what that means is that we're not only pumping diverters in our frac techniques, but we're also shutting in and allowing reservoirs to heal and rest before fracking again, whether it's in that stage or in the next stage. And what that's creating is a very complex dendritic frac, and we're seeing not a lot of extension in half length, so our recovery factors are increasing dramatically in our wellbore. So we're now accessing more oil and gas in the same kind of half length of the wells that we've drilled. So we're not starting to condemn other locations, but increasing our EURs that we're expecting from our wells.
That's interesting. All right, so let's talk about the industry now that it's come out of the most recent period of declining oil prices. What's next in your view? What should oil and gas companies be focused on, let's say, in the next few years?
Yeah, I think that a lot of the public markets right now are expecting oil and gas companies to live within cash flow. We're seeing a lot of investors wanting to see that cash recycled and to see production to grow with it, to kind of prove out our thesis of our rates of return at the wellbore level. On the private side, we're probably not much different, although we're in a pretty heavy growth model right now. So I see really our company over the next few years continuing to raise private capital, to look to access the public markets via reverse mergers or an IPO with our growing asset base. But I think it all stems back to being able to prove out our base rate of return in our wells, that the 40 to 50 to 60% that we're publishing and our rates of return are actually materializing, and that we're seeing that drop to the bottom line for our investors. As long as we continue to do that, we'll still see a lot of investment in our industry. But I think that the previous strategy within our industry of trying to grow through debt or trying to grow through the capital markets is probably going to hold off for a while until we can see cash flow reinvested and the rates and the production rates grow from that.
All right, let's talk, Luke, a little bit about the primary message that you want people to take away from your presentation at the conference this year.
Yeah, I think we're interesting, and our narrative is interesting because we're talking about a basin that other people aren't today. So the Arkoma Basin, being in the eastern part of Oklahoma, really doesn't catch the headlines like you hear Scoop and Stack and the Merge plays in western Oklahoma. So really our takeaway from our conference is to educate investors about some of the non-name plays that are happening in the U.S. and the excitement around them and what rates of return are associated with those plays. We are a private company. We don't plan to be for the long term, and so when we're ready to discuss with public investors about what we're doing in our basin, we certainly hope that there's a baseline education knowledge about what our play is and how we can see some interesting rates of return from our investments. So overall, we're certainly like other basins. We're trying to grow. We're trying to establish what baseline rates of returns are. But I think as we look out over the next couple of years, we're going to have an interesting asset and an interesting enterprise that will be available to investors.
Exciting time, huh?
Yeah, it is. It very much is for us.
All right, Luke Essman, President and CEO of Canyon Creek Energy. Thank you very much, Luke.
Yeah, thank you.
I am Angie Austin for Oil and Gas 360. Thanks for joining us.